Right. Thank you very much. Hello, everybody. Good evening. Welcome to today's session. So we, as you can see from the slide, even though we're still part of non-resident taxation, we're just branching out to the next phase of non-resident taxation, especially having looked at from the domestic law perspective. Today, we are going to dive into the tax treaty aspect, which I've been referring to on and off in the last 3 sessions while dealing the non-resident taxation from a domestic law perspective. So today, we'll also look at a tax treaty perspective. Now, as always, before I move ahead with today's agenda and session, I think it'd be apt if we just have a quick recap of what we did the other day. Because we essentially covered the balance aspects that pertain to taxation of non-residents from a domestic law perspective. We saw the incomes, we saw taxation of NRIs, what are the incomes that is exempt from tax, and some presumptive taxation for non-residents as well. So with this, let's just do a quick revisit. Again, as always, I would request you all to participate, put in your answers. Meanwhile, I'll also discuss them, as part of giving a quick recap on that as well. Now, if you look at the first question that's in front of you, a foreign company with a PE in India, what is PE? I will also elaborate more on PE today, the fag end of today's session. But as I already indicated, PE is similar to business connection, which you have seen in section 9, clause 1, subclause 1. So therefore, essentially, if a foreign company is trying to have a place of business in India, again, doing business in India, then a PE automatically triggers. So the equivalent of a business connection in the tax treaty parlance, which again we're going to look today, is the permanent establishment, and that is very commonly harmonizedly known across the world. So basically, India uses it in the domestic law business connection, but however, from a tax treaty parlance, it is nothing but permanent establishment. Now, when a foreign company which has a PE in India, which means it has a business connection in India, could be either through a branch office or a subsidiary, now receives fees for technical services from an Indian concern. Now, the question is, how is the taxability of such income is governed? Does it come under section 9, clause 1, subclause 7, which is fees for technical services, as you have seen earlier, deemed to occur in India? Or is it section 44BA? Or is it section 44BBA? Or if you feel it's none of the above? Maybe, I don't know, is it 115A? Could be one question. Then none of the above. So I wanted to give you an answer as to what do you feel, how the income will be governed under the income tax law, under the Income Tax Act for this foreign company which has a PE in India. So this is basically an additional variant which we saw in the last class. That is a foreign company which has a PE in India, and it gets a fees for technical services. Then section 44DA. So the answer to this would be 44DA. So 44DA says, look, 917 is applicable only when you do not have a PE. You do services from your home jurisdiction. You don't come to India. In those situations, 917 will apply. But if you have a PE in India, then 44DA will take over because you're effectively doing business in India. So therefore, 44DA is just like how you compute your profit and gains on net basis taxation. Because as you all know, 917 goes on gross basis taxation. So if you have a PE in India, they're saying have your books, do a tax audit, file your tax returns, pay your net tax, and the tax rate will be 40%. So therefore, one needs to be extremely vigilant and cognizant of the fact that if a foreign company has a PE in India and it gets a fees for technical services, then in such scenario, section 44DA will attract. There's no PE, straight away tax at section 917. Read with section 115A. So 115A stipulates what is the rate that governs fees for technical services, interest, royalty, etc. Now, moving on to the second one, this is where we trenched upon presumptive basis of taxation. Because in many situations, foreign companies do have a fee in India, but then it's very difficult to determine or maintain books of accounts due to the nature of the business. So therefore, the Income Tax Act gives certain specific presumptive basis of taxation for such foreign companies doing business in India. One such is 44BBA, which is for aircraft or a foreign airline company which is providing or getting revenue through carriage of passengers and goods from India, including passengers and goods belonging to India. So now in this question, a foreign airline company operates aircraft between Colombo and Chennai. The foreign company made an income amounting to 10 crores on account of carriage of passengers from Chennai, India. The foreign company does not want to opt for Section 44BBA, which is a presumptive mode, because under 44BBA says on your gross, pay 5%, show 5% of income, pay necessary taxes to it. Now, it doesn't want to show that 5%, it wants to show a lower amount because it believes the income for taxation should be less than 5%. So therefore, it says it does not want to opt 44BBA, which is a presumptive basis. Can it do so? Is the contention of the non-resident assessee valid? Can the non-resident opt for it? So the obvious only two possibilities. One, yes, it can opt for direct method. What I mean by direct method is show your income minus expenses, typical conventional basis in how you determine income for taxation. Or the other possible answer could be no, not valid, because 44BBA is a mandatory provision, no option to declare lower profit. That is, there is no other method to declare lower profit. The answer to this will be, it does not have an option. And if you look at this particular table, it does not have an option to show less than 5%. So 5% of receipts is the only option available. It cannot show. So these are small nuances that I wanted to bring it to your specific attention. That's largely because if you say 44BB, if you feel that your income is less than 10% of receipts, the option is available. 44BB, as you can see, is for foreign companies or non-residents providing services or facilities in connection with equipment hire for using in extraction or prospecting of mineral oil. 44BBA, which we are now concerned, talks about operation of aircraft on account of carriage from India. 5% of receipts, you do not have an option. So mandatorily, you would have to pay. So you do not have an option to declare a lower version. Having said that, so we'll move on. So please watch out for these small nuances. The possible reasoning could be normally aircraft business, you may wonder why is the government doing it? So please understand there's a fiscal policy rationale to or whatever the government is doing. The possible rationale that I could envisage was, normally aircraft businesses aren't very, lucrative, cash rich. So there's a possibility that with oil prices being fluctuating, they may, possibly want to attribute losses to India. You can always have an option. So therefore, to avoid such mechanism, they say, look, I'm not asking you much, pay 5% of your taxes and then keep moving on. So that could be the possible reason why they're not giving another alternative option. Now moving on, with Chapter 12. Chapter 12 is determination of tax in certain special cases. We saw 115A is a part of Chapter 12, that is interest, royalty, FTS, specifically for foreign companies or non-residents. Tax rates are determined under Section 115A. We also looked at foreign institutional investors under 115AD. Now, one more aspect that we looked was 115BBA, taxation of sports person, entertainers, and sports association. Now, if you look at this question, Mr. Bravo, a rap dancer, was invited to perform in the IPL tournament held in the UAE The BCCI had paid INR 25 lakhs for his performance in the inaugural opening ceremony, whatever. Will the income be liable to tax under Section 115 BBA of the Income Tax Act? I want you to, obviously, two answers, yes, taxable or not taxable. Please give in your answers as well. It will help you to understand how better you have tried to grasp those provisions. So 115 BBA, as you may know, main aspect is the participation or entertainment. It should they are performance based. So when I mean performance based, so obviously there has to be a physical element of performance. So the question is, this performance is happening in UAE. That is very, very crucial. So therefore, since if you look for entertainers as well as performance, anything, the main nexus factor, connecting factor is the performance should have happened in India. So in the given case, since the performance is happening in UAE, 115 BBA will not be applicable, because 115 BBA will trigger only if the performance is happening in India. Please note, these are again small aspects that one need to be really mindful about. Now, moving on, last to recap before we move to today's session. Which of the following is not a specified foreign exchange asset for the purpose of Chapter 12A, more specifically Section 115C? If you recollect, did mention as part of non-resident taxation that the government has a special concessional regime or a special regime for non-resident Indians who are basically citizen of India or person of Indian origin. So they are governed under Chapter 12A and 115C. Now, if you look at Chapter 12A, which 115C talks about definitions, that is to non-resident Indian who invest in certain foreign exchange assets. Now, 115C specifically mentions what are those assets. Now, that is precisely the question here. The question is which is not a specified foreign exchange. This is again test your memory largely. Which is not a specified foreign exchange. Is it debentures of a public company, shares of an Indian company, deposits of a public company, debentures of a private limited company? So if you look at 115C, specified assets mean shares in Indian company is a specified asset. Debentures issued by an Indian company which is not a private company is a specified asset. Deposits with an Indian company which is not a private company is a specified asset. So which means debentures of a private limited company is not a specified asset. So answer to this will be 4. Debentures of a private limited company is not a specified foreign exchange asset. Last one, NRI who has only investment income and long-term capital gains specified under Chapter 12A, that is for non-resident Indians. For this particular NRI, for these incomes, taxes has been withheld, and this NRI contends that she need not file a return of income. Is the contention valid? Obviously, again, 2 answers, yes, valid, or no, not valid. The answer is 115G gives specifically that the NRI need not furnish a return of income if her total income is only investment income and LTCG, and tax is deductible under the provisions of Chapter 17B. So if tax is deductible under the provisions of Chapter 17B, then in such a situation, there is no need for her to file a return of income. So answer to this will be yes, valid. She need not file a return of income. So with this, we broadly see if there are any questions. Broadly covered the aspects that we have looked into earlier. Okay, Gopinath has a question. What is purchase in convertible funds? A US, correct. Yes, Gopinath, you've given the right example. So basically, any foreign exchange that is convertible, if you see Indian rupee is not a convertible capital, but we're not a convertible currency yet. So therefore, any USD is a very popular convertible foreign exchange. So therefore, a US citizen stands for USD to Indian account and purchase shares. That is convertible foreign exchange asset. The idea is basically money should, foreign currency should come from foreign to Indian. All right. So with this, I'll move on. Now, as you would have seen, which I have alluded to in the previous sessions as well. When it comes to non-residents, first step should always be looking at the domestic law. Look at the tax base, whether it's taxable under the domestic law. If yes, then you go to tax treaty. So tax treaty follows domestic law because there's always a normal, a conundrum, a chicken and egg story that always happens in the tax fraternity. Should I first look into tax treaty or should I look into domestic law? My approach, which I feel is it would be a more sensible approach, is first look at your domestic law because all your domestic law gives you the taxing rights, taxing mechanism, and that's where the sovereign power is also there. So look at your domestic law, see if you are taxable on your foreign income for residents or non-residents as well. And then you go to tax treaty to see if there is any possible relief that you can avail. Now that's why if you see the session is also, the topic is also titled double tax relief. So therefore the idea itself is to ensure that the treaty will alleviate or reduce, avoid, getting income doubly taxed. Now, this again we discussed on the first day when I started with the general taxation systems. But then now that we're going to get into tax treaty, we will revisit this again to better understand why do we need a tax treaty, why do we need an international tax law. Now, if you look at this particular example that's before you, an Indian company, which is a service recipient, and there is a South African company, which is a service provider. So the South African company provides service to India, for which the Indian company makes payment towards the fees for the services provided by the South African company. Now, what is the taxability of income in India for the South African company? You all know this. We have dealt this extensively. Section 917 of the Income Tax Act. Fees for technical services deemed to arise in India because the services are utilized in India. So therefore, the South African company will have to pay, will have to suffer tax in India. Section 917. Now, under the domestic laws of South Africa, under their domestic law, the same income will also get taxed because South Africa, just like India, will also tax on a resident basis. So when a resident basis, worldwide income is taxable. So which means in South Africa, the South African company will again offer that income to tax in South Africa. Now, what is the net result? Double taxation occurs. If you look here, Indian company withholds tax while paying to South African company as fees for technical services. So out of 100 rupees is what their service fee is. India will deduct 10 rupees, 10% is the rate under 115A, and they deposit 90 to South Africa. So when the money goes to South Africa, it will only be 90 and 10 will go to the Indian government's kitty. Now in South Africa, this 100 income, because that's what they would have raised in their invoice, will get taxed in South Africa because it is a resident, and being a resident, worldwide income is taxable. So again, in South Africa, whatever rate it may be, 30%, 25%, will have pay tax. So effectively, if you say the same income is getting taxed twice, one time in India and one time in South Africa. Now, so what will happen in this case? If I am a South African company, I would not then want to do any cross-border trade or services. I said, let's not do anything outside South Africa because we are unnecessarily paying tax in India and the same income anyways by being a resident we are paying in South Africa, in home country. So we're getting doubly tax. So let's not have a cross-border trade. Let's try to have only domestic income. This way, there won't be any double tax. But this is a very narrower way of looking at things because we are in a globalized world and you need to have cross-border movement of trade and services. That is very essential, not only because we are in a globalized, but it also helps improve government relationship and other aspects. So now, but the biggest problem is how to do it because there is a double taxation. Now, before I go further and dwell how to solve this, there are basically two kinds of double taxation that you need to know. One is the juridical double taxation. That is, this example is a juridical double taxation. That is, same income getting taxed in two different jurisdictions. One in India, it gets taxed and also gets taxed in the home country, the resident country. So in the source country, it also gets taxed. And in the residence country, it gets taxed. So this is called a juridical double taxation. What is economic double taxation? Economic double taxation is same income getting taxed twice, but in different hands. It's called economic, in two different persons. It's called economic double taxation. When will that happen? Your transfer pricing cases. If you have already touched upon transfer pricing, you can relate. Transfer pricing essentially has an economic double taxation. How? If an Indian company, there is a transfer pricing adjustment being made, then the India will also, there will be a tax. And consequentially, I will have to pass on this to my South African, to my home country or wherever my transfer pricing is. So there also it will get impacted. So that's called economic double taxation. I will not go deep into economic double taxation. If you understand the transfer pricing principles, you can very well understand the economic double taxation. So basically what economic double taxation is, same income getting taxed in two different hands. Juridical double taxation is same income getting taxed in the same person, but in two different jurisdictions. And tax treaty largely addresses juridical double taxation. So in the previous example, tax treaties will help South African company from juridical double taxation because the South African company first gets taxed in the source country by India, then gets taxed by the resident home country in South Africa. So this juridical double taxation, the tax treaties try to give a remedy. So therefore, having seen double taxation as a major issue, because it will be a huge cost, look from a South African company perspective, both countries now want share. So therefore, tax is a cost. So therefore, the cost will increase. So there is obviously double taxation. For this, the tax treaty, or in other ways called as the international tax law. Now, what is international tax law? International taxation refers to treaty provisions relieving international double taxation. Look at the term here, relieving. It relieves you from double taxation. In broader terms, it says, there will only be one point of taxation. If you are, only in one place, either in your resident place you will be taxed or in your source place you will be taxed. You will not be taxed in both the jurisdictions. So international tax law or tax treaty helps in relieving international double taxation. Now, how is this done? This is done through, as I already mentioned, through tax treaties. Now, I don't need to much on this. You all are familiar with what a treaty is. Treaty is basically like your conventions. If you recently have followed in the news, the climate convention, the Paris Climate Convention. So it's basically countries coming together and trying to enter into agreement. So the legalized form or the colloquial term that is used, legal jargon that is used is treaty. It can also be called as convention, charter, covenants, whatever you want, but more famously known as treaty or a pact. So Article 2 of the Vienna Convention on Law of Treaties. Vienna Convention on Law of Treaties is like the constitutional aspect or how to interpret treaties comes under VCLT. It defines treaty basically as international agreement concluded between states. So that is why it is very important. Now these treaties are entered between states and not by private persons. What private persons enter are agreements, contracts, framework, whatever you call. But when countries enter, it's called a treaty. So which means the tax treaties are entered by country. That is India with Netherlands, with Germany, with US, with UK. And India has more than 100 odd treaties. Now, why do you need to sign these treaties? We've already seen one major reason is to relieve double taxation. But let's try to understand more holistically. From a government side, this will help how to relieve double taxation. So basically, India will also want to tax, the other country will also want to tax. So both will come together. I'm sorry. Both will together bilaterally negotiate and say, okay, look, you tax this, I will tax this, or let both of us tax it. We'll see how to give a relieving mechanism. So this way there is a clarity. So government will come, because please understand, taxes are a sovereign issue. It is a fundamental indicator of sovereign. Today, India can come and ask its citizens, pay your taxes. So tax is an identity for sovereignty that will determine the power which a country has, a sovereign power. So therefore, this is a very touchy issue and a very sensitive issue from a country standpoint. And no country wants to lose its tax revenues to another country that easily. Because taxes are a major revenue factor to build infrastructure. So it has a huge impact on the social fabric of the country. So therefore, governments have to be very, very mindful about it. Therefore, by entering into tax treaty, the governments will clearly come to an agreement as to how to go about in relieving double taxation. How much will you tax? How much should I tax? How to go about all those things will be there in the tax treaties. Another major aspect from a government standpoint is this will encourage more foreign investment coming in, because there will be a lot of clarity. Okay, let's go to invest in India, because we know what is the tax rate. India and my country has entered into a tax treaty, so we will get to know. We are very convinced that the income will not be doubly taxed. So therefore, from a government standpoint, it encourages foreign investments, which obviously will result in more jobs, more investment, more infrastructural development, etc., more taxes. From a taxpayer standpoint, it gives him or her a clarity. Okay, I'm going to invest in one state. Let's assume tomorrow you want to invest in Tanzania, you want to invest in Jamaica, you want to invest in Uganda, or you want to invest in Europe. You would want to have clarity. Tomorrow you're putting your money and you don't want certainty. This is very important. Certainty as to what is the tax implication and tax cost. Now, let's more get into the legal aspect to it. Now, as I've indicated to you, one of the major objectives of a tax treaty is to ensure that there is to avoid double taxation. Now we are going to see how that is going to happen. But not only that, if you look, section 90, which is the main section which authorizes the central government to enter into tax treaty. Constitution gives powers to India to enter into treaties. Now, Section 90 of the Income Tax Act gives powers to the central government, that is the CBDT, to enter into tax treaties, and for what purposes it can enter into tax treaty. Now, if you look, first and very primary reason is there in Section 90, subsection 1A, elimination of double taxation by providing relief. So we're going to see how it is done. This is one of the primary reasons. Now, another reason, this was recently introduced. I will touch upon it at the end. We have one more treaty called the multilateral instrument. You would have heard about it by now, the BEPS MLI. This is for double non-taxation. So what started as a treaty to relieve double taxation, sad part, since multinationals started to use tax havens, treaty shopping, sadly, what was supposed to be elimination of double taxation became double non-taxation. So therefore, to eliminate double non-taxation, that is, they don't pay tax anywhere. So to eliminate double non-taxation, central government gives powers to India to enter into treaties, and India has signed a multilateral instrument convention. It's called, as part of your syllabus as well, the BEPS MLI. So the idea is, the objective rather is to eliminate double non-tax, because the existing bilateral tax treaties were entered for giving relief for double taxation. It never anticipated double non-taxation, because these treaty concepts started very early in the early 20th century, because trade was very important for a very simple fact that if countries started to engage in trade relations, then they will not fight with each other. So the First World War, the Second World War, in order to ensure there are no world wars coming in, the best way is to be interdependent on each other. So that way you start getting interdependent on each other, then you will not get into wars. So that's why it was very important to promote cross-border trade. And hence, one of the impediments of a cross-border trade is double taxation. So to avoid this double taxation, countries started to enter tax treaties in the early 20th century. But over a period of time, when multinational enterprises started to come through globalization in the late 20th century, or the globalization epoch in the post or starting stages of fourth industrial revolution, multinational enterprise started to use these treaties for completely avoiding taxation. So thereby it became a double non-taxation, for which a follow-up treaty was entered called the multilateral instrument. I'll briefly touch upon it later. Our focus will largely be in elimination of double taxation by providing relief, Section 90, subsection 1A. And apart from elimination of double taxation, there are other reasons also. That is, the treaties will also help in exchanging information to combat tax avoidance and tax evasion. So if you look, India has also entered a separate treaty called Mutual MCAA, Administration Convenience Treaty, Cooperation Treaty, which is basically again a multilateral treaty where exchange of information. If India wants information about Indians who are having Swiss bank account, they can request, or now it's automatic. So Swiss authorities will keep providing information. Similarly, India will provide information about other non-resident who are having financial accounts in India. So how will you do that? Treaty gives you a mechanism. So treaties are also entered to give exchange of information, which will help to combat tax avoidance, tax evasion. The treaties will also help in recovering income tax in India as well as in the foreign territory. Collection of taxes and recovery of taxes is also very important, because once you sign treaty, because all these are public international law, when you sign treaty, you need to abide by it. What if I don't abide by it? What I sign a treaty and I don't share information? what I do, I sign a treaty and I don't collect taxes or I don't help in collecting taxes, then the other country can take you to the International Court of Justice, like you would have seen in the Kulbhushan Yadav case, India taking Pakistan. Similarly, we can always take other country to International Court of Justice and say, look, they have violated the treaty. They have not lived up to the treaty objectives or treaty principles. So I want to file. So far, we have never had such situation in taxation where a country has taken another country to International Court of Justice. What has happened is countries have terminated treaties. They say, thank you very much. You are not living up to what it is. So I'm going to terminate your treaty. They have never filed a case or allegations against another country. They've only terminated. So broadly, these are the major aspects for which a tax treaty is entered. Elimination of double taxation by providing relief, elimination of double non-taxation, MLI, we're going to look at it, exchange of information to combat tax avoidance, recovery of income tax in India as well as in the foreign territory. And the underlying theme for all these is promoting fairness and cross-border trade. This is not specifically meant because trade is mentioned, but the underlying objective of doing all these things is to bring fairness in overall tax system and thereby promote cross-border trade. This is very important. Now, another very significant aspect, having seen why we have looked into treaty, what is the objectives? In order to give more powers to treaty, Section 90, subsection 2 of the Income Tax Act says the provisions of the Act shall apply to the extent they are more beneficial. That is, in other words, treaty or act, whichever is beneficial to assessee will prevail. So therefore, when there is a conflict happening between an act and treaty, the provisions more beneficial to assessee, he can choose either act or treaty, whichever is beneficial to the assessee. For example, act specifies a rate of 20%, treaty gives only 10%, then I can use the treaty rate. Under the Income Tax Act, it is exempt from taxation. Under the treaty, it may be taxable. Then I can always go and choose the act because that is more beneficial to me. So basically, DTAA acts like, as Professor Klaus Vogel, who's a renowned international scholar, says, it is more like a stencil over domestic tax laws. So what essentially he means by stencil, you all know what a stencil is. So your domestic law plays a major aspect and DTAA comes as a stencil and wherever possible tries to relieve double taxation. You can also look at the Karnataka High Court in Aram Muthaya. Very beautifully, the court would have encapsulated the relationship between DTAA and domestic law. That is, it would have said, if no tax liability is imposed under this act, question of resorting to the agreement would not arise. So that's why I say first your starting point should be Income Tax Act. You're in Income Tax Act because tax treaty will never give a taxing right. Taxing right, when I mean taxing right, you cannot invoke a tax through a treaty. Tax will come only through act. Treaty will only relieve you. So therefore, for example, if there is no tax liability is imposed, that income is exempt from tax under the Income Tax Act, treaty cannot make you to pay those taxes. So if no tax liability is imposed, question of resorting to agreement would not arise. Why? Because the objective of tax treaty itself is only to relieve double taxation. No provision of the agreement, that is tax treaty or double tax avoidance agreement, can possibly fasten a tax liability where the liability is not imposed by the act. Now, this is situation 1. No tax under the act, no need to go to treaty. Situation 2, if a tax liability is imposed by the Income Tax Act, the agreement may be resorted, that is the double tax avoidance agreement or tax treaty. I keep using interchangeably. When I mean tax treaty, I mean the double tax avoidance agreement. The tax treaty or the double tax avoidance agreement may be resorted for negating or reducing it. So basically to reduce or negative double taxation. In case of difference between the provisions of the Act and of the treaty, the provisions of the treaty will prevail over the Act. That is, if the provisions of the treaty is beneficial to the assessee. Let me give you one example for you to better appreciate the point what I was trying to mention. Now look at this particular question before you. A resident of country A wins a lottery in country B. Now, under the domestic laws of country A, where he is a tax resident, casual incomes, that is lottery incomes, are not taxable. Say take Middle East normally, casual incomes are not taxable. Under the treaty between country A and country B has the taxing rate. So they are saying the treaty, any income from other source, the taxation will be with country B. Now, ironically, under the domestic laws of country B also, lotteries are not taxable. However, by virtue of the treaty, country B wishes to tax. So repeat the question again. A resident of country A wins a lottery in country B. Under the domestic laws of country A, casual incomes are not taxable. Under the domestic laws of country B also, lottery winnings are not taxable. However, treaty between country A and country B says any income pertaining to casual income, country B has the taxing rate. So the question is, can a treaty give a taxing rate? Can a treaty be a sword? So this is the shield or sword analogy. Can a treaty be a sword? No. Treaty can only be a shield. That is, if the domestic law is not taxable, I don't even need to go to treaty because only my domestic laws tell me whether I'm taxable. If my domestic law says I'm not taxable, I don't even need to go to treaty. So that's the very essential fundamental aspect that one needs to be aware about. So having seen why we need treaty, one of the major objectives is to eliminate the double taxation. Let's try to see how this double taxation is being eliminated. First, we will focus on there are two ways in which double taxation can be relieved. That is by giving a unilateral relief. So what do you mean by unilateral relief? That is, the country itself will say, I'll give you foreign tax credit. Whatever taxes you have suffered in other country, I will give you as a rebate. That is just like how your TDS is. I will give you as a credit. So you can, from the overall tax that you need to pay, you can deduct it. So that's why it's called a credit. So you can use how we say, right, input credit for GST. We say tax, how much is the TDS credit available? Similarly, foreign tax creditors, what is the credit? If you have paid tax, you are a resident and you have paid income for which taxes has been paid in the source country, then by virtue of being a resident, your global income is taxable. So the country gives you a unilateral relief. That is, since the income is doubly taxed, you can claim a tax credit in India on the taxes that you have suffered in the foreign country. So the foreign country tax will be given as a credit in India. That's why it's called a foreign tax credit. Now, this is unilateral. Why I say unilateral is, the bilateral is the treaty between the two countries will tell you how to go about giving tax credit. Normally, what happens, they will give a credit. Sometimes, some tax treaties which India has entered gives an exemption. Now, what do you mean by exemption? What do you mean by exemption is the foreign income need not be included in India tax. I repeat, an Indian company has a foreign income, and that foreign income has suffered tax in the foreign country. Now, ideally, being a tax resident, your global income will be taxed. So, in your global income, you will include both your Indian income plus your foreign income, and then find out the tax. Now, under credit method is pretty straightforward. So, whatever is the total India tax that is coming, you can take a foreign tax credit to it. So, India normally follows credit method, but there are very few instances where exemption method. So, this is largely bilateral. That treaty should specifically mention it. What happens in the exemption method is, if the treaty says exemption method is used for giving or eliminating double taxation, then the foreign income need not be included in the India tax return or computing India tax. So the foreign income is exempted. You will pay only tax in the foreign country. You don't need to include it in the India tax. So that's the biggest advantage you get in a exemption method. Only the Indian income will be taxed. Your foreign income will not be taxed in India. It will only be taxed in the home country. Maybe I'll give you. Give an easy example for you to say. You are an Indian company. You have a foreign income of say 100 rupees. You have Indian income of 200 rupees. So your total income will be 300. That is 200 of your Indian income plus 100 of your foreign income. Now, in the foreign country, you have suffered a tax of 20 tax. Now, what happens normally in India is, for this 300, let's say 30% average tax, 90 less foreign tax credit, 20. So your total taxable income will be 70. Now, what happens in an exemption method? If the bilateral tax treaty has this exemption method, then in India, your total income will only be 200. So tax will have to be borne only for 200. So 200 into 30% will work out to 60. So if you look at your overall total tax outflow, in foreign country, you would have paid 20. In India, you would have paid 60. So your total tax will be 80. So exemption method is you don't need to include the foreign income in your Indian home country. And India will not tax you on your foreign income. So this is broadly the exemption method. But India does not, in India's many of the tax treaty, we do not have this concept of exemption. The India largely follows a foreign tax credit method. Now, coming back to unilateral relief, what if there is no tax treaty? Let's assume I have let's take this example to appreciate this. Go to your problem sheet. Problem number 37. This will give you a idea about how foreign tax credit works. Let's look at question number 37. Mr. ARR is a musician deriving income from concert in Bahrain during the financial year 21-22. He was paid rupees 10 lakhs, for which tax of rupees 2 lakhs was deducted at source in Bahrain, where the concert was performed. India does not have any agreement with Bahrain for avoidance of double taxation. Assuming that the Indian income of ARR is 5 lakhs, what is the relief due to him under section 91? So ARR is an Indian musician, tax resident of India. He was paid 10 lakhs for a concert in Bahrain. There is no tax treaty between India and Bahrain. And in Bahrain, for him performing there, they had withheld or deducted tax of 2 lakhs. Looks like they have withheld tax at 20%. Now, he also has an income of 5 lakhs in India. So he needs to know what is the relief due to him under section 91. So under section 91 of the Income Tax Act, it gives unilateral relief. That is where there is no tax treaty, India gives a credit. Now, there are some conditions that we need to follow and certain measures that is stipulated in section 91 before finding out what is the relief that is available. Now, relief will be available if the assessee is a resident in India. So, in our case, Mr. ARR is a resident of India. He has paid income tax in a country outside India in respect of income which accrued or arise outside India. So essentially, that income should not have accrued or arise in India, which is, yes, not the case. It does not accrued or arise in India because the performance happened in Bahrain. So yes, and they have also deducted tax. So tax has been paid. So they are paid to the Bahrain government of 2 lakhs. Third, India should not have a double tax avoidance agreement with that country under section 90. Because normally, if you have an agreement, the agreement will tell you whether exemption method or credit method. As I already indicated to you, India's majority of the treaty, India goes only by credit method. Very, very similar to what you will going to see in section 91. So India believes in giving credit rather than exempting it. Now, anyways, section 91, where unilateral relief, yes, India does not have a DTL agreement with Bahrain. Now, section 91 is eligible. All the three conditions have to be satisfied. He has satisfied. Now, the moot point is, will I get credit on the entire tax that is paid in Bahrain? Now, if you look in the question, in Bahrain, it looks like they have flat on gross basis withheld 20%. Now, normally, this is called the nominal tax rate. So when you do it at gross basis, similar to what we do in 115A, 115 BBA, these are called the nominal basis. That is the headline rate, the gross basis, nominal tax rate. But actually, if you see, you all know, when it comes to effective tax rate, which you compute by your average of tax on total income divided by your total income, normally your effective rate will be much lesser than the headline rates or the nominal rates. In India, for corporate tax, they say nominal rate is 22%, 25%, LLP is 30%. But if you look, effective rate will be much lesser. Why? Because you would have got some Chapter 6A deductions, rebate, etc., etc. So therefore, what India is saying is, find out what is the effective tax rate. That is, find out what is the average tax rate in India, and your foreign tax will be restricted to that effect. So if you can see, relief will be restricted to the lower of Indian rate of tax or the rate of tax in the foreign country on the doubly tax income. So your relief will be restricted to the lower of Indian rate of tax or the rate of tax in the foreign country on the doubly taxed income. So whatever income is doubly taxed, the relief will be restricted to the lower of your Indian rate of tax or the rate of tax. What is the Indian rate of tax? Tax on total income divided by your total income, your average tax rate. Whatever it comes. So let's say this comes to 15%. And the foreign rate comes to 20%, then your foreign tax credit will be restricted to 15%. Lower of for will be restricted to 15%. Will be restricted to 15%. So this is basically to ensure that, see, we are trying to give credit. So they are saying, I'll give you credit up to India tax, whatever taxes you have paid in India. More than that, which means Indian government is giving over and above. So therefore, the idea is to reduce the relief to the lower of Indian, whatever is the doubly taxed Indian rate. To that effect, I will give you. Why? Because tax on my total income. Because total income is after giving effect to your Chapter 6A deductions. So normally, after giving your deductions, your effective tax rate will always be lesser than your nominal rate. I repeat, nominal rate again is the headline rate. Effective tax rate will always be less than your nominal rate, because when we say a country has a corporate tax rate of 9%, 10%, that is called nominal rate. But if they all may have some deductions given, R&D credits given. So what matters is your final effective tax rate. So that will tell you. So now they are saying restrict the rebate to your to the extent of your effective tax rate. Now you will understand this better. Now let's see what is how to go about it. First, let's compute the total income of Mr. ARR. His India income is 5 lakhs. His foreign income is 10 lakhs. So total income works out to 15 lakhs. So what is the tax payable? He comes under the highest slab. So therefore, the tax payable will be 5 lakh, will be 1 lakh 50, that is 5 lakhs into 30% plus I'm doing general basic computation under this slab 1,12,500. That is this is nothing. What I'm trying to do is only the basic tax computation from the slab rate. So this, as I've already done some computation. So if you look, the overall, so the tax comes to, anyway, we'll do it again, 262,500. Add your education cess, there's no surcharge. So add your education cess of 4%, it works out to 2,73,000. This is very simple. I'm not pure mathematics under your slab rate computation. I don't know if nowadays, I'm sure many of you in your articleship softwares would have helped you compute. But at times, I think you should go back to your calculator. Softwares won't help you in the exam. Or Excel would have saved you. But in any case, the point is my tax payable comes to 2,73,000. So now let me find out what is my Indian rate of tax. That is tax on total income divided by total income. This works out to 2,73,000 divided by my total income of 15 lakhs. Comes to 18.2%. So this is what I was trying to mention. Now, if you look, you may normally think I come under the 30%. So my nominal rate would be 30%. But if you look, because of slab rate benefits, progressive schedular system, of course, we have a progressive tax basis. So therefore, your effective tax rate comes only to 18.2%. Now, what is my doubly taxed income? Let's find out what is my foreign tax rate. Foreign tax rate is simple. On 10 lakh, my foreign tax is 2 lakhs divided by my foreign income of 10 lakhs, which is 20%. Because in the question it's very clear. He was paid 10 lakhs, that's my foreign income, for which tax of rupees 2 lakhs was deducted. So my foreign tax rate would be 20%. Now relief under section 91 will be restricted to 18.2% on the doubly taxed income. So therefore, relief under section 91 will be 18.2% of 10 lakhs, which works out to 1,82,000. So final tax payable for Mr. ARR will be 2,73,000 minus 1,82,000. 2,73,000 was my this thing, less relief under section 91, which we computed, came to 1,82,000. So my tax payable will be this, whatever. It works out to 91,000 will be my tax payable. Ideally, what would have happened is I would have got, if not for this, I would have taken a 2 lakhs of relief and my tax payable would have reduced further. But 91 relief clearly says the tax, foreign tax will be restricted to the lower of Indian rate of tax. So this is the same for bilateral tax credit computation also. So relief will be restricted to the lower of Indian rate of tax on the for doubly tax income. So I will repeat again. First, find out the total income of the Indian resident. Indian income, and I have a foreign income of 10 lakhs. My total income comes to 15 lakhs. Find out what is the, will also include the education cess. My total tax payable works out to 2,73,000. So now I need to find out what is my average rate of tax, average Indian rate of tax. It comes to 18.2%. Tax on my total income divided by your total income. That is, what is the tax that you're paying in proportion to your total income? It comes to 18.2%. Now, what is the foreign tax rate you're paid? Foreign tax rate is 20%. So relief under section 91 will be restricted to lower of Indian rate of tax or foreign tax on the doubly taxed income. So it will be restricted to 18.2%. So therefore, on the doubly taxed income, apply 18.2%. That will be the relief available under section 91. That you can claim as a foreign tax credit. The balance will give you the net tax payable. Okay, I'll Vignesh has a question. I'll answer that later. It's a more system oriented. If there is any specific question on the relief computation, please let me know if you're clear. We will also try to solve your material. If you look at this particular illustration, now let's look at this illustration. Nandita, Michelle. So I'm in illustration 2 in double tax relief material. You basically explains what we did in ARR's problem, section 91 relief. So it all boils down to mathematics if you are able to understand the concept. Effectively, at the end of the day, your relief under section 91 will be restricted to the lower of the Indian rate of tax or your foreign tax. Let's look at this to better understand and have a clear picture on how relief under foreign tax credit relief works. Nandita, an individual resident who is a retired employee of Prasar Bharati, age 60 years, is a well-known dramatist deriving income of 1,10,000 from theatrical works played abroad. So she's a dramatist and she has derived income of 1,10,000 from performance made abroad. Tax of 11,000 was deducted. So looks like they withheld tax 10% on gross basis. India does not have any double tax avoidance agreement under section 90 of the Income Tax Act with that country. Her income in India amounted to 6,10,000. So she had an Indian income of 6,10,000. In view of tax planning, she has deposited 1,50,000 in PPF and paid contribution to approved pension fund of LIC rupees 32,000. She also contributed 28,000 to central government health scheme during the previous year and gave payment of medical insurance premium of 26,000 to insure the health of her mother, a non-resident age 84 years. Compute the tax liability, assuming she has not opted for the alternative regime 115 BAC. Now, the point which the illustration tries to emphasize is basically saying, look, when you do your total income, you're going to give benefits for these chapter 6A. So if you see PPF deduction of 1,50,000 is available. There's an approved pension fund of LIC under 80CCC. She gets 32,000. So she gets chapter 6A deductions. Now she has an Indian income of 6,10,000. We saw that. Indian income of 6,10,000. She has a foreign income of 1,10,000. So a gross total income works out to 7.2 lakhs. ATD, I'm not going into the, it's not the objective. You all know ATD better than. So ATD, you get benefits available, 28. So finally, giving effect to chapter 6A of around 2,03,000. So the total income works out to 5,17,000. The total income works out to 5,17,000. Now we need to determine the tax payable. So tax on 5,17,000. She's a senior citizen, 80 years. So therefore, basic exemption limit goes to 3 lakhs. And if you keep that in mind and find out, compute the income tax payable, it will work out to 13,400. And you have an health education says add 4%. The total comes to 13,936. Again, I don't need to spend time on how you arrive at 13,400. Simple slab rate computation. Please do watch out that she is 60 years old. So read the question properly. So that way you'll get a higher basic exemption limit. So if you look, her final tax payable comes, India tax payable comes to 13,936. Now, what would have happened is normally, if they had said complete full credit is given, that is whatever you have paid in foreign, complete amount you would have got, then this is called full tax credit. It would have come to the entire 11,000 I would have taken as credit. The entire 11,000 I would have taken as credit, and my tax payable would have only been 2,936. Normal scenario, I'm talking about a generic scenario, just like how you take a TDS credit, whatever foreign taxes you have suffered, I'm going to give you the entire foreign taxes. It's called the full tax credit. Then should have got an opportunity to claim everything. But India has not opted for a full tax credit. India has opted for a limited tax credit. So what it means by that is, I will restrict the foreign tax credit to average rate of tax in India. So now let's find out what is the average rate of tax in India. That is my tax on total income divided by total income. So tax on my total income 13,936. My total income is 5,17,000. So average rate of tax works out to 2.7%. So look at this, whopping, it just comes to 2.7% is what the average tax rate for Miss Nandita. Now, therefore, let's see what is the rate of tax in foreign country. We've seen this before. It looks like straight 10% on 1,10,000. So if you look, my average rate of tax in foreign country is 10%. So my foreign tax credit will be restricted to lower, which is 2.7%. So therefore, on the doubly taxed income, the doubly taxed income is the foreign income on 1,10,000, 2.7% works out to 2,966 or 3, whatever. That is what I'm eligible to claim as a relief, and my tax payable will now come to 10,970. Had I given a full tax credit, my tax payable, if you recollect, came to only 2,936. That is whatever foreign tax amount that I suffered, the entire foreign tax credit was given as a credit. I would have paid only 2,000 something. But India says, no. We will not give you full tax credit. The foreign tax credit will be restricted to the average rate of tax that you have paid in India, to the effective tax in India. To that effect, I will give you credit. So this is the small computational mechanism that you need to be aware about while claiming relief under Section 91. This mechanism is also the same in all the tax treaties. India, in all the tax treaties, would have said my tax treaty credit will be restricted to the average rate of Indian tax. So this is the concept. What I want you to do is go further down, just to ensure you have understood the concept better. I want you to, without looking at the solution, try question number 2. Same thing. You cannot go to, sorry, I want you to try question number 3. You can try question number 3 to better understand the concept. So now, an examiner would generally want to test, in terms of Chapter 68 deduction and find out what is the relief available. So without trying to look at the answer, just try question number 3 and see if you are able to arrive at the exact relief under Section 91. Only thing that you need to be mindful here is the medical insurance premium paid. So these are Chapter 6A. So if you recollect ATD, the maximum allowed is 50,000. So therefore, and payment is made through credit card. So ATD is allowed because ATD says you cannot do it through cash. So since credit card is very much allowed, the amount is 50,000. So these are small, the numbering, these are the basic provisional aspects that you need to be aware about. If you get this wrong, then obviously the entire tax on total income will go for a toss and your rebate under Section 91 will also go for a toss. Because rebate under Section 91 or relief under Section 91 is dependent on your effective tax in India. That is your average tax on total income by total income. So if you somewhere go wrong on deduction under Chapter 6A while determining the total income, because they're not concerned about gross total income, they're concerned about total income. So therefore, you should be extremely careful in getting the total income right. Get the total income right, rest is all mathematics. So try question number 3. If you're done with the question number 3, you can also look at question number 9. Okay, thank you, Puneet, for giving it a try. You can verify question number 3. I don't know what do you mean by. I mean, I think that's your final tax payable. So you can look at, verify the answer in question number 3. 548, 520. I think you've got it right. Good, Puneet. So, as you would have seen, for those who have done question number 3, it's quite straightforward. At the end of the day, you need to get your total income right. And once you get your total income right, it's easy to compute tax on total income because that's the normal computation mechanism. Then find out the average rate of tax. That is your effective tax rate. Now, if you had noticed in question number 3, the average rate of tax in India worked out to 24.6%. And the average rate of tax in the foreign country came to 15%. So lower off. So effectively speaking, I get the entire, because my average rate of tax in India is on the higher side in this example, which is 25, and my average rate of tax in foreign country, where they have tax at 15%. Now I'll get the entire, because lower of average rate of tax in India or average rates of tax in foreign country. So in this example, the lower is the average restricted to lower of foreign country. So I get the entire foreign tax that I've suffered. I will get it as credit here because my average rate of tax in India is on the higher side. Please look at question 9 as well. Question 8, we will not do here, but I would request you all to look at question 8 during the weekend or whenever you get time, whenever you're going to sit on this. But please look at question number 8 as an assignment. Try solving it. Question 9, on that same note, just to finish question 3, please also have a look at question number 9. Now, the only aspect to watch out in question 9 is obviously, you need to be familiar with the fact that you can claim deduction under section 80 QQB. So this being a past exam question, the idea of the examiner was to again test your knowledge on chapter 6A deductions as well. So you can take 80 QQB deduction, which is basically royalty income. So that's a specific deduction available on royalty income for residents under 80 QQB. So that is one significant aspect to watch out. And there is also a business loss in another country. So a question that comes about is, should I set off this business loss? This is a very, these are some of the interesting aspects you will come across normally in foreign tax credit on a practical level. Because why should a loss that I made in another country being set off in India? Because Indian government's argument will be, next year when you make income in that country, why don't you set it off in the future? Why are you setting it off with India tax? So your India tax base will get reduced because these are base reducing. My tax base will get reduced if I set off my business loss of a foreign country which I do it. But what the question specifically mentions is the domestic tax loss of country N does not permit set off of business loss against any other income. So therefore, we can provide the business loss. Had the business loss been allowed to be set off against another income in country N, then that could not have been set off in India. That should have been ignored because in the subsequent years, they could have set it off or they could have set it off with other incomes there, and you will only have the net income that is taxable in India. Net income that you make and then you bring it into India tax. But nevertheless, the question says that the domestic loss of country N does not permit. So therefore, you can set off this business loss in India. So this particular line, therefore, becomes very important. Does not set off permit. So therefore, you can set it off while computing the business income. So as you may see here, income from profession carried on in India, 8,50,000. There is a royalty income for which you have also incurred certain expenses. So therefore, you can deduct those expenses and take 5,50,000. And then you can also set it off with your business loss in country N, because the question says it cannot be used in the other country. So therefore, your gross income from profits PGBP will come to 12,90,000. Agriculture income in country N. So these are some of the aspects which they'll try to test you at the exam level, whether you're able to think smartly. Agriculture income is exempt under section 10(1) only for Indian agriculture income, not for foreign agriculture income. So therefore, this 1,30,000 will be taxable as income from other sources. Normally, under the exam pressure, we may try to circumvent. We will assume that this is exempt, but please look, this is on country N, not India's agriculture income. And dividend received is another income from other source. Your gross total income works out to 15,05,000 minus your 80 QQB of 3 lakhs, which is availed under, which can be up to 3 lakhs can be claimed as royalty income, royalty against your royalty income as deduction. So total income works up to 12,05,000. Computation of tax liability, straightforward, 30%. So therefore, comes in up about 10 lakhs. So therefore, it works out to total including cess, works out to 1,80,960. Now, rebate under section 91, your average rate of tax in India, that is tax on total income, which is 1,80,960, divided by your total income, which is 12,05,000, and it comes to 15.01%. Average rate of tax in the other country is 18%. This is 8%. It is given here. The rate of income tax in country N is 18%. It's there in the question already. So obviously, the lower of the two. So on the doubly taxed income, the foreign tax relief will be restricted to only 15.0174%. Now, what is the doubly taxed income? It should be doubly taxed income. So agriculture income of 1,30,000 is doubly taxed. Royalty income, after setting it off with your deduction under 80 QQB, what is the doubly taxed? So royalty income works out to 2,50,000. So effectively speaking, royalty income gets taxed only for 2,50,000 because we are talking about doubly taxed income. So since I claim a deduction under 80 QQB in royalty, so my effectively doubly taxed income is only 2,50,000. Then there is a dividend income of 85,000, which works out to 4,65,000, and you can obviously set off your business loss. The final doubly taxed income works out to 3,55,000, which has to be restricted to 15%. So the nuances, of course, the nuances here is you figured out that rebate under Section 91 is restricted to lower of average rate of Indian tax or the average rate of foreign tax. But what is very significant from an examination standpoint is getting this steps up to total income in the right manner. So please watch out for it, for which you need to have a overall understanding on the other provisions as well. Because if any of these goes wrong in any of the steps above, then automatically it will result in a wrong rebate under Section 91. So please be mindful about that. Namita, treaty will prevail if there is difference between domestic law. But in the question on question number 9 or 8, wherever we've discussed, the question clearly says there is no tax treaty. So the idea itself is to ensure that you have an understanding on how 91 works. And normally at the exam level, they'll specifically tell you whether it's taxable or not if it's a bilateral tax treaty or a treaty based. Because even though India has entered a lot of tax treaties, and all these tax treaties are negotiated. So it's not standard format everywhere. So you need to be, and at the exam level, they may not test you, go into each, this treaty, this provision. So therefore, they will largely try to restrict with a situation where there is no tax treaty. All you need to know is, please understand that if it's a treaty or domestic law, whichever is beneficial will be applicable for you. Now, one last aspect on the unilateral tax relief that you need to know is, if you go back to the question, the ARR question which we started with, where we find out relief, I want you to focus on point B and C. So this is the additional variation. Fact remains the same, that is ARR who performed in Bahrain, no tax treaty, tax was withheld at 10%. Now, the question goes further. Mr. ARR specifies that apart from TDS, the organizers had also withheld a sum of rupees 75,000 towards local municipality fee where the event was located. ARR wishes to ascertain whether the said fee can also be claimed as foreign tax credit, as it is collected, is similar to a tax, because ARR felt this is akin to a local municipal tax. A municipal fee was collected in that area. Maybe for what's the reason, for cleaning, whatever. Is this, can I also, apart from TDS, they also deducted less municipality fee, can I deduct, is the question. Now, point number C also I think we'll touch. I'll answer B and C together. In the facts above, ARR also wants to ascertain about any other procedural requirement that he needs to comply to avail the foreign tax credits. Is there any procedural requirement to avail the foreign tax credit? Now, this is where I want to bring in the foreign tax credit rules. India did not have foreign tax credit rules until 2017 under the domestic law. Now, you may ask, why do we need rules? Because there are a lot of practical issues that were coming up. For example, in question D, whether municipal fee can I treat it as a tax? And some assessees were claiming credit on that also. So, Rule 128 of the income tax rules, by virtue of the power under Section 295, which the CBDT has, came out with a guidelines as to what are the rules that one need to follow to make foreign tax credit. So there the rules clarified, Rule 128. You have the features of the rules in the study material also, which you can have a look at it. It clarified what a foreign tax is. The foreign tax will include taxes that pertains to business, but will not include interest, fee, or any penalty that is paid. So any interest you may have paid in the foreign tax, country tax, or any penalty or any fee, whatever name it's called, those will not be eligible for foreign tax credit. So Rule 128 gives you those kind of a clarity. Similarly, there may be situations where that country would follow a calendar year. India follows a financial year. So there may be some overlap. Which year I should claim, which year I should not claim. Can I claim Jan, Feb, March of next year in this year? So you get all these, especially US goes on calendar. So those things have been clarified in the foreign tax credit. Similarly, I do not agree with the foreign tax that was levied in the foreign country. So I filed a case or disputed in the local court there, or a local tax officer, tribunal, whatever. Then what should I do? Can I be eligible? No. The foreign tax credit says you cannot claim those disputed taxes as foreign tax credit until you get a clarity. So foreign tax credit rules gives you those advantage. I mean, clarity in terms of procedural aspects. One other important aspect is the last part to the C question. What is the other procedural requirement? Now, you need to file called Form 67 in order to claim foreign tax credit along with the return of income. So the government says, in order to claim foreign tax credit, the taxpayer has to file a form called Form 67 that will specify a lot of details as to what is the nature of income, what is the tax suffered there, what is the tax withheld, the tax paid, all those details in Form 67, which you can also have a look at it from the income tax website. Many of you would have already been familiar with it while filing the tax returns of residents who have had foreign income. And that has to be filed along with the return of income. Now, what if I don't file along with my return of income? Then you will not be eligible to claim foreign tax credit. So this is like your Form 56F in 10AA, where you have to file certain forms in order to avail those exemptions. Of course, there are different arguments that no, they're not mandatory, they're only directory. I'm not getting into it, but the bottom line is India wants to know, the Indian government wants you to file Form 67 along with the return of income to be furnished within the due date of filing return of income. So the foreign tax credit rules therefore gives you clarity in terms of when to claim credit, how to claim, any issues. So it's a much needed guidance for taxpayers, because taxpayers, resident taxpayers always had a lot of issues on the procedural aspects. So that got clarified thanks to introduction of foreign tax credit rules. So what we will do now is we will take a 10-minute break and then reassemble at 7:55. So what we have done now until now is the understanding how double taxation relief is availed. So double taxation relief is availed through a mechanism called tax credit, and it is restricted to a lower of Indian rate of tax or rate of tax in a foreign country. This is normally called as ordinary credit. Full credit is whatever I paid in foreign tax in foreign country. If I claim the entire amount, that is called full credit. But India does not recognize full credit. We go by a system called ordinary credit. That is, the credit will be restricted to the average rate of Indian tax or the rate of tax in the foreign country, whichever is lower. So this is what the mechanism helps you to eliminate double taxation. That is by providing a relief mechanism. We will look into other few nuances after the break in terms of how the tax treaty mechanism works. So let's take a break and then reassemble at 7:55. In the meantime, any questions, please feel free to post. I did see a few questions. I'll answer them. But yes, just have a look at question number 5. This gives a summary of whatever we have discussed. An individual resident in India having income earned outside India in a country with which no agreement under Section 90 exists. The individual wants to examine whether credit on foreign income will be allowed against this income tax liability. Yes, allowed. Section 91 gives you a benefit, and the deduction is allowed from the Indian income tax payable by on such doubly taxed income at Indian rate of tax or rate of tax, whichever is lower. So we saw that. And 91 should be read with Rule 128 on foreign tax credit. Foreign tax credit rules basically says that you need to file Form 67 and you cannot claim interest, penalty, fees as foreign tax. So this is what we had looked at. I did see some question. For example, Kaushini has raised the question, country N does not permit to set off business loss, but in answer it is deducted. See, Kaushini, that is what I had mentioned. The question says that country, the foreign country, does not permit to set off with any other head of income. So now normally what happens is, if that country had allowed, look at this situation. This is foreign country, say this is country N. Now, in here, the concerned year, you have a business loss of 100. Now, what it says is that country N does not allow to set off with any other income. So, therefore, this 100 rupees could not be set off nor could be carried forward to future years to set off with other income, because it says there is no option to set off. So, hence, in India, where you are a tax resident, you can claim this 100 and set it off, because income includes loss under Section 224. And as much as income is also getting taxed, you can also bring your losses. So that is what would have happened in the question. They would have given a reduction. If you go to question 9, they would have given a set off. The point which you are raising, Kaushini, is because the country does not permit set off against any other income. So therefore, the loss that you have, you are absolutely entitled to bring it into India and set it off. Now, had the question says, if country N allows you to, then what would have happened the next year? Year 2, that will be, I would have got, let's say I would have got an income of 100. I could have set it off with the business loss of 100 I had in the previous year, and my income would have been 0 and nothing. I don't need to add anything in India. So that's why the question goes one step, clarifies that there is no set off. Had the question said set off is possible, then we would not have set it off. We would not have brought it into India books at all, because you can use next year to set it off. We would have ignored it. We would not have treated it off. Since the question specifically said it is not possible, so that is why we had included it. I hope this is clear now, because this otherwise will give undue advantage, because I would have taken in India also loss. Then again in that foreign country, next year I will also again set it off with that income and reduce that country's income also. They call it this is called double dip benefit. Normally they used to do all sort of things in tax treaties, but anyway, that's slightly at the advanced level. I will not get into it. But please understand the concept. Concept is, you are an Indian resident, your global income has to be included. Now, global income means income will also include loss. Now, can I include all the losses then? You can include only those losses which you cannot set it off in the foreign country, which you cannot carry forward and set it off in the foreign country. If you are able to do that, then India will not give you that benefit. They will say, go take advantage in the home country. You tell me finally what is your net income. I will give. In the given case, they have said, look, I have a business loss. That's my net final. I cannot do anything with that. Okay, in that case come, you can include it as part of your business loss. I will deduct it from your total income, and accordingly, proportionate tax will be given. I hope you're clear now, Kaushik. I did see one more question. Sir, if the average rate is not mentioned in question, we need to calculate. I don't know which average rate you are mentioning, Jaydev, because average rate for India, you need to compute. Tax on total income, total income. Average rate for foreign country is very easy. They would not have given the rate. They would have said tax has been paid in the foreign country 2 lakhs, total income 10 lakhs, 2 lakhs divided by 10 lakhs, 20%. So you can find it out, even if the average rate, same way. Average rate would be your tax on whatever foreign tax divided by your foreign tax income. Normally, you will be able to find it out. And invariably, it will be on a gross basis, just like India. So they will give it, or you can easily find it out. Naveen, see, Puneet, if Indian agriculture is given, then you don't need to include at all. Indian agriculture is exempt. How will it? It will not even come into your gross total income. So why are you worried about it? Only foreign income will come into picture. Exempt income, though, it will not even get inside your gross total income. Straight away exempted. Okay. Naveen, yes, possible. You can claim it. In fact, you can definitely avail the exemption. But please understand, the basic exemption, you have to watch out if it is section 112, 112A related. Otherwise, you can avail. So I will move on to, so having looked at foreign tax credit, let's move on to the other sections relating to tax treaty, which you should be aware about. If you look at question number 38, for assessment year 22-23, Mauritius Limited, a Mauritian company, lent a sum to its 90 subsection 2 we already discussed, that is treaty or act, whichever is beneficial. I'm just trying to make you understand this better through an example. A Mauritius company lent a sum to its subsidiary ABC India. So ABC India, while making the interest payment to Mauritius, had deducted tax under the rate of 7.5%, as prescribed under the India-Mauritius Tax Treaty. The AO initiated proceedings under section 201 of the IT Act for shortfall in deduction of tax, as the AO contended that the TDS rate should be at 20% as specified under section 115A. Is the contention of the AO valid? No, contention of the AO is not valid. Not valid because the crux of 92 is this. 92, you can choose treaty or act, whichever is beneficial to the assessee. Since 7.5% is beneficial. There are some procedural requirements to be followed. I will explain that later. Subject to procedural requirements under section 94 and 95. We will look at 94 and 95. On 92, same thing, you can also look at question number 6. Income Tax Act provides for taxation of a certain income earned in India by Mr. X, a non-resident. The double tax avoidance agreement, which applies to Mr. X, provides for taxation of such income in the country of residence. So this is one step, slight variation to 90 subsection 2. Here for the non-resident, the treaty states the taxing right or the allocation of taxation, distribution of the taxing right is with country of residence. This is possible because normally in tax treaties, the country will say if it is a income from other sources or it is a capital gains, then capital gains will be taxed only in the resident state, or other incomes will only be taxed in the resident state. So these are treaty variations. So here the question also says, in the double tax agreement, which X country, where X's home country has entered with India, it says that income will only be taxed where the country of residence is. So therefore, X says, X wants to determine whether it needs to pay tax in India. It need not, because 92 says whichever is beneficial. So he need not pay tax in the source country. It is enough if he pays in the country of residence. Section 92 makes it clear where central government has entered into a DTLA with a country outside India, then in respect of an assessee to which such agreement applies, the provisions of the Act shall apply to the extent they are more beneficial to the assessee. So therefore, if the taxing right is only in his home country, then there is no need for him to pay tax in India. So therefore, he can avail the treaty benefit. Now, let's look at 94 and 95, the procedural. Same thing like what we saw, an Indian taxpayer. So what is the procedural aspects that I need to look at? Because if you see in the previous example which we saw, where he need not be paying any tax in India, it is if the treaty says it is only taxable in the country of residence, then whichever is beneficial to him, so he can avail 92. Similarly, here we saw that the shortfall, that is the interest under India-Mauritius treaty is only 7.5% compared to 20% under 115A. So treaty rate is lower. Now, what section 90 subsection 4 and section 90 subsection 5 says it, before giving the treaty benefit, if you are going to take treaty benefit, then the non-resident who is availing the treaty should give a certificate called tax residency certificate. That is, he should give a tax residency certificate that he belongs, he's a resident of that country. And not only that, section 95, which was which came into the provision as well, because a lot of these tax havens like Mauritius were ready to give tax residency certificate. They are actually taxing, no real substantive activities was happening, but people were just getting the tax residency certificate and saying, look, I'm a tax resident of Mauritius, look at this tax residency certificate. So what government did is to be more proactive, went one step further and said, you have to give your TRC and you also have to furnish certain details in a specified form. Form 10F, ask name, address, etc., where are you, where is your office, and all those things. So these are procedural aspects. So if a person wants to avail treaty benefit, he has to get his TRC and also give additional information specified under section 90 subsection 5. So coming back to question number 6, which we discussed, where Mr. X, who is a non-resident, wants to take treaty benefit. Section 90 subsection 2 gives you the treaty benefit. If you can see the answer, it also goes and says, before giving, I mean, it's just not about giving section 90 subsection 2 benefit, that is Treaty or Act. The concerned person must also give a certificate, tax residency certificate, and give all the information in form number 10F. What is his status? If he has any PAN in India, nationality, tax identification number in that country, etc., etc. So essentially, what the government has done is to ensure that people don't misuse treaties. Now, why and how they can misuse treaty? As I mentioned to you, all these tax treaties are bilaterally negotiated treaties. So there are a lot, when you negotiate, just like your agreements, there always be giveaways and takes. You give something, you take something. Because two countries are coming together and they are trying to say who will tax whom, how much they will want. So there will always be give and takes. So sometimes, for example, in Mauritius, what happened when India negotiated tax treaty with Mauritius? One of the clauses in India-Mauritius tax treaty was any capital gains that a Mauritian resident gets will only be taxed in Mauritius. I repeat, a Mauritian resident earns any capital gains. It may also be from India. But the India-Mauritius treaty says the Mauritian resident who gets capital gains, the taxing right is only with Mauritius, shall be taxable only in Mauritius. So which means India gave up its taxing rate. This is as per the India-Mauritius tax treaty. So what happened? A lot of foreign investors who wanted to come to India used Mauritius route to get into India, because tomorrow when Mauritius, when they want to exit, when they sell the shares of Indian company, it will only be taxed in Mauritius. In Mauritius, there was no capital gains tax at all. So effectively, you can go tax-free. There will not be any capital gains tax. So therefore, you will, why did they do like this? See, there are political, there are negotiation. I'm not getting into that. But you need to understand all treaties are bilaterally negotiated, and sometimes bargaining power also comes into it. Because when developed country negotiates tax treaty with developing countries, they will try to have an upper hand because they are exporting capital. And as a developing country, you want more capital, more FDI coming into India. You are an capital importing country. So you want more capital. So more foreign investment comes, better it is for you because jobs, infrastructure. So a lot of these developing low income country will normally have a less bargaining power because they want money to come into their country through investments. So they will sometimes agree to all these beneficial provisions. Be that as it may, the point is, what the government wants is, okay, fine, these are treaty negotiated, we can't do anything. But to ensure that genuine Mauritian resident gets benefit, they have gotten these additional procedural compliance like giving a tax residency certificate and other forms. So it is not just taking the treaty benefit, you should also prove that you are a resident of that country by furnishing a tax residency certificate. And you should also provide additional information in form number 10F. Now, this is very important. You take this specific question. Indian company ABC India is withholding tax at 7.5%. So the onus is on the resident deductor. When they take treaty rate, the resident deductor must obtain all these information. Mauritius Limited, can you please give me your TRC? Can you also submit all these information in Form 10F, only upon which the treaty rate in Mauritius can be adopted. If TRC is not provided, and if 10F details are not provided, ideally you should not be giving a treaty benefit, because section 90 subsection 4 and subsection 5 specifically says if you are going to go by treaty, then you need to get TRC, tax residency certificate, and other information under 10F. Now, having seen the procedural requirement, let's look at question number 39. This is extension to the interest payment question in 38. Here, the assessing officer invoked the GAAR provisions. For those who, I'm sure you will be familiar with it, but if not, the GAAR is General Anti-Avoidance Rules. This is under Chapter 10A of the Income Tax Act, where the assessing officer, if he believes that a transaction is entered to evade or avoid tax, then he has the power to recharacterize or treat the arrangement as impermissible. So it's called General Anti-Avoidance Rule. It gives complete powers to the assessing officer to recharacterize if he feels that an arrangement or a transaction is basically for avoiding or evading taxes. Now, in the question number 38, the assessing officer feels that the Mauritian entity is only a sham entity. That is, there is no substance in it. So what it does is, it invokes the GAAR provisions under Chapter 10A and denies the lower rate of tax specified. I have mentioned GAAR panel. I know this is not part of the previous discussion. We'll have a separate discussion on anti-avoidance, but nevertheless, just one additional on information on GAAR. Just because an assessing officer feels that the transaction is shady, he cannot royally invoke GAAR. He will have to take that case to a GAAR panel. Now, this GAAR panel, GAAR panel, General Anti-Avoidance Rules panel, is a very neutral panel, unlike your poem panel. Because in GAAR, the panel is one income tax officer, one academic, and one from the legal community. So you will have a diversified group. This was recently introduced. So the AO must go and take this case to the GAAR panel. The GAAR panel will scrutinize the transaction. And if the GAAR panel feels that, yes, this is to avoid, this transaction is done to avoid taxation or evade taxation, they can agree with the AO and says, yes, please invoke the GAAR provisions under Chapter 10A and recharacterize or nullify the transaction. So in the question, I mentioned that the GAAR panel also agreed to the AO's contention that the Mauritian entity is a sham entity, and therefore the lower rate of tax specified in India-Mauritius Treaty should be denied. That is, the Mauritian entity should not get treaty benefit. Now, Mauritius Limited contended that GAAR provisions under the domestic law cannot override tax treaty. It says 90 subsection 2, which says whichever is beneficial to the assessee. How can you now say GAAR provisions I have invoked and you cannot take treaty benefit? When the treaty gives me the benefit, why are you doing a treaty override? That is, through Domestic Act, why are you doing a treaty override? Now, this is to avoid such kind of questions. Section 90 subsection 2A of the income tax has been amended or has been included. I need to find out the relevant portion. This is the one. However, 90, that is, this is coming as part of section 90, subsection 2A. However, the provisions of chapter 10A, general anti-avoidance rule, shall apply to the assessee, even if such provisions are not beneficial to him. So, which means treaty override is possible. So, assessee cannot choose treaty if it is a GAAR invoking mechanism. That is, provisions of chapter 10A can be invoked. An assessee cannot claim shelter under section 90 subsection 2. So this is a very significant mechanism. So whereby, coming back to this question, is the contention of the Mauritius Limited valid? No, it is not valid because GAAR provisions can override tax treaty. In other words, assessee cannot invoke treaty provisions even if they are beneficial to him if GAAR has been invoked by the AO. So GAAR basically gives a tool to the assessing officer so that people don't misuse tax treaties and do treaty shopping. Now, having looked at the benefit available treaty, when it can be invoked, when it can be denied through GAAR, one more aspect that we need to look at is section 90, subsection 3. Now, what does it say? Just look at this question number 40. The assessing officer, while undertaking assessment of XYZ GmbH, a German company, for assessment year 22-23, held that poem of XYZ is in India, and hence it will be treated as a tax resident of India. The assessing officer contended that under the India-Germany Tax Treaty, Article 4.3 stipulates that where by reason of provisions of paragraph 1, a person other than an individual is a resident of both contracting states. Let's say in Germany, they say tax residency is determined by incorporation. In India, we all know tax residency can be invoked if the place of FD management is in India. So a company can be a tax resident in Germany. A company can also be a tax resident in India. This is also common for individuals. A person can be a tax resident of India as well as for tax resident of other country, because normally the residentship is determined under the domestic laws. In India, 182 days criteria. In another country, it can be something else. It can be, say, 150 days, or it can also be domicile, to have a permanent house or domicility. So, domestic law variant. So, therefore, a person can be a tax resident in both the countries. So therefore, in such scenarios, tax treaties specify something called a tie break. You can only be a resident in one country. Because if you are resident in both the countries, then it becomes chaotic. The purpose of tax treaty itself is to eliminate double taxation, and it will say whether which country will tax, whether it's a resident country or source country. If it is taxed in both the country, then resident country should give foreign tax credit. Normally, foreign tax credit will only be given by a resident country because that is where your worldwide income is suffered. So resident country will give you foreign tax credit. So therefore, you can be a resident only in one country. If you are resident in both the countries, then the tax treaties has something called a tiebreaker clause, similar to your tennis tie break. When you are in 6-6, then the game is, or the next set you can go on if there's a tiebreaker, and the winner will be determined through a tiebreaker. Similarly, tax treaty is all something called a tiebreaker clause. Now look at Article 4.3 in front of you. Under this question, under Germany, by virtue of being incorporated, ICAI will be a German company, German tax resident. But Indian AO says you have place of effective management in India, so therefore you become a resident. Now, he is a resident in both the states. So to break the tie, Article 4.3 of the India-Germany Treaty says a person other than an individual, so which means a corporate entity or a non-individual, if he is a resident of both contracting states, then it shall be deemed to be a resident of the state in which the place of effective management is situated. So the tiebreaker is broken in such a manner where the poem is, that state is where he will be a resident. So therefore, the assessing officer now says, look, in order to determine the poem guidelines, I went through the CBDT guidelines given because the term place of effective management is not defined under the tax treaties. So the assessing officer, Indian assessing officer says, I relied on the poem definition in India and also took the guidelines given by CBDT, and therefore, in my view, the poem is in India. So therefore, you have to be an Indian tax resident. Naturally, as a German company, you will say, why did you choose place of effective management definition under the Indian laws? You should have taken under my country law. Normally speaking, place of effective management is a general term not defined in treaty. So we need to see whether should we go to the Domestic Act to see if that definition is specified. And this is what 9 subsection 3 tries to address. What it says is, if a term is used in a DTAA and not defined in the agreement, but subsequently the central government gives a meaning to it, that meaning will have to be taken effect too. Term used in any DTAA with a foreign country which is not defined. So place of effective management is not defined in the treaty, but if it is defined in the Income Tax Act, then the term shall have the meaning assigned to it in the Income Tax Act and explanation, if any, given to it. So 90 subsection 3, and you also have some related explanations to it. Some of which were also, the explanation was also as brought up to bring the poem guidelines. It says that if a DTAA term is not defined, and if it is defined in Income Tax Act, you should adopt that terminology. So therefore, the action of the assessing officer AO is valid because of section 90 3, which stipulates that a term not defined in DTLA but defined in the Income Tax Act, then that definition will have to be adhered to. You may ask whether is this the right way to do it. If they have not defined, can unilaterally a country come and define it and say, no, you have to follow only what? I am not getting into that. That is a legal issue. That again, we go back to public international law issues. But the legislation has clearly given a validation to it, saying if a term is not defined in DTAA but defined in Income Tax Act, then you have to use the definition given in that Income Tax Act. So this is what section 93 does. So I repeat whatever we have discussed. The overall broad principle, if you see, is the objective of treaty is to give unilateral relief, so to give eliminate double taxation through foreign tax credit, and we saw how the relief mechanism happens. And the another main principle of treaty is 90 subsection 2, wherein you can choose treaty or act, whichever is beneficial to the assessee. If you are choosing that, a non-resident is choosing a treaty, then he has to give a tax residency certificate to show that he is a resident of the other country, and he should also provide additional details under Form 10F. So, having seen how the treaty works, and one more aspect that we also looked into is the applicability of the GAAR principle, General Anti-Avoidance Rule. A treaty benefit will not be available if GAAR provisions are invoked under Chapter 10A, which is a anti-avoidance mechanism. So to curb or ensure that tax treaties are not misused, 90 subsection 2A says that GAAR will override your tax treaty. And 90 subsection 3 basically says if a term is not defined under the treaty, but if it is defined under the Income Tax Act, then that definition under the Income Tax Act has to be given meaning. You have to resort to that meaning. And also, I need to mention here that normally if you see treaties, they are negotiated by diplomats. So the treaty will have some generic terms, may not have legal language to it, like how you see in Income Tax Act, notwithstanding, shall, without prejudice to, without foregoing. You will not have those legal jargons. It will be slightly a general English language. So there will always be room for interpretation, because if you use generic terms, it will always lead up to various ways of interpreting. So treaty interpretation is slightly different to your statutory interpretation. So don't worry, at your level, they may not go into the treaty provisions and ask you to interpret treaties, because each treaty has its own different variations and different aspects. Some treaties, as you can see before you, some treaty may not have clauses on fees for technical services. Some treaty won't have, any other substantive provisions, and PE definition will be different. So therefore, each treaty has its own variations. So they will not try to test you on the interpretation of a tax treaty. But you need to understand the basic principles that treaty or act, whichever is beneficial, can be used. You need to furnish tax residency certificate and Form 10F if you want to avail treaty benefits. And if GAAR is invoked, you cannot avail treaty benefits. Now, these are all some of the aspects you will see in a tax treaty. Not getting into it. But one very significant last bit on the double tax relief is we already touched upon here, Section 91B, elimination of double non-taxation. So all these while, we have seen how to get relief under double taxation. Because the objective here was, it's a single tax principle. A person should pay tax only in one jurisdiction. If he pays in both the jurisdiction, either you give a credit and relief or give him an exemption. But what had happened is over a period of time, many people misused. So it became a situation where there was a lot of double non-taxation happening. So therefore, the G20 countries came together and started a project called BEPS, Base Erosion Profit Shifting. It's called the OECD G20. OECD was asked to come out with measures to counteract tax avoidance. So they came out with a multilateral instrument, which basically gives out mechanism only to avoid taxation. What are the ways in which a country can ensure that a double non-taxation is stopped or a tax evasion is avoided? Now let's take this example for better understanding. Question number 42. This is how a typically tax avoidance strategy or tax evasion strategy happens through the tax treaty network. A US entity wants to enter into Indian market by setting up a subsidiary in India. However, the tax advisors of US entity advised the US company set up an intermediate holding company, which will then set up the Indian subsidiary. So it will be US company, which will set up a Netherlands company. Underneath will be the Indian company. Ideally speaking, it should be US company, which is setting up an Indian company as a subsidiary. But tax advisors of US entity said, no, don't go directly to India. Have an in-between company in Netherlands. Now, why? The reason for setting up the Netherlands entity is driven by a taxation purpose. That is, under the tax convention between Netherlands and India, the withholding tax rate on dividends is only 5%. Further, on sale of Indian company shares in the future by the Netherlands intermediate holding company, if they want to exit India business, they will not suffer any tax, capital gains tax, as under the India-Netherlands tax treaty, the capital gain taxing rate is with Netherlands. And in Netherlands, the capital gains are exempt from taxation. Is this tax avoidance? If so, how to counter this under the Income Tax Act? So basically, if you look, the entire objective of setting an intermediary holding company in Netherlands is to take the taxation benefits available under the India-Netherlands tax treaty. Otherwise, US entity had no interest to set up a Dutch entity. They ideally wanted to come to India by setting up an Indian company, Indian subsidiary. Had they done that, probably the tax cost would have been high, because under the India-US dividend may be at 15% or 20%. Then again, there will be capital gains tax. They found out that, okay, Netherlands is very attractive because this is called treaty shopping. Under the India-Netherlands treaty, you have only 5% dividends, which is very less. India will only withhold 5%. And then there is no capital gain tax tomorrow when I sell the India business. So Netherlands look attractive. So now what the BEPS did is, they came out with an action plan to counteract tax avoidance and tax abuses. And that's how the multilateral instrument was signed. A multilateral instrument is an addition to the tax treaty. That is, it will modify the existing tax treaty. It is like your codicil in your partnership deeds or any deed. So you put a codicil, and then which means it is like your add-on to your tax treaties, but you are trying to now plug the leakages. The advantage of the multilateral instrument is you don't need to keep renegotiating all the tax treaties, because negotiating tax treaties is not an easy job. And India has hundreds. So similarly, worldwide, there are around 3,000 tax treaties. So at one single shot, a multilateral instrument, if we sign, whatever there in the multilateral instrument will get added in the existing tax treaty. So this is, again, the objective is to ensure that there are no treaty abuses happening. That is, tax dodgers and tax evaders don't misuse tax treaty for avoiding taxation. Again, I will not get deep into the BEPS mechanism because that's a separate chapter in itself and you have a separate focus on that. But one of the significant aspects in MLI is if the principal purpose is availing a tax benefit, then you're not entitled to that tax treaty. So in the question that we saw in 42, the principal purpose or the main purpose for which the Netherlands entity is set up is only for availing tax benefit. So therefore, by virtue of the BEPS MLI, the Indian assessing officer can deny giving tax treaty benefits under the India-Netherlands treaty. So this is what elimination of double non-taxation is, and that was through the MLI agreement which India has signed along with some 90 odd countries who have signed till date. MLI is active in India. So MLI ensures that there is no double non-taxation or a reduced taxation through the treaty shopping mechanism. So this is why I just wanted to give you an example as to what is elimination of double non-taxation. Elimination of double non-taxation is this. That is, you try to enter into this treaty with conduit companies in low tax jurisdictions or tax havens. Now, thanks to MLI, you can now stop these treaty abuses or the treaty shoppings. So elimination of double non-taxation can be avoided has been avoided by MLI, and India is a signatory to the MLI, multilateral instrument too. You can read more about BEPS in the BEPS chapter. So just to quickly, therefore, to sum up on double tax relief, it is for providing elimination of double taxation by providing relief through a credit mechanism. We saw that. And then similarly, when you take a treaty relief, you should also ensure that you submit your tax residency certificate and other aspects. And you should also, you can choose treaty or act, whichever is beneficial to you. Now there are quite a lot of, if you go to the illustrations or the exercise in the material, please have a look at them. I know we've covered quite a lot of bit on double tax relief, so I'm not going to go through it, but I would strongly advise, please look at the exercise problems starting from question number 1 to 8. All these are something which we have already discussed and which are all part of section 90. So please, go through it, especially question 1, question 4, and question 7. I want you to have a look at question 1, 4, and 7. And the others are on foreign tax credit, computation. So that is also very important because an examiner will try to test not only your understanding on 91, but will also try to check your overall understanding on the other mechanism like deductions under chapter 6A and arriving at a total income. So what I will do is I still have advanced ruling to touch upon. So with this, what I've done is we are done with the double tax relief, the basic concepts as such. We are left with advanced ruling. Now, very quickly on advanced ruling, of course, I'll be sharing the slides. But the main idea of advanced ruling was it is a dispute prevention or a resolution mechanism. The idea was, look, there is so much uncertainty, whether I should give the treaty benefit, what is the tax rate, will this treaty be eligible? So what the government did is, to bring certainty to foreign investors, they introduced the concept called authority of advance ruling, which is actually a quasi-judicial body. Now, this was coming under the Ministry of Law, and you can go in advance. Look, I'm a non-resident. I'm going to enter into a transaction with an Indian company, and I want to know what is the taxability. Imagine, how wonderful it is. These are all ex ante. I go with clarity, so that will give me a lot of clarity. Okay, fine. The advance ruling says you will be taxed at 10%. You will be taxed so and so. So very clear. I don't need to tomorrow worry about assessment, harassment, retrospective amendment, nothing. And AAR was set up with this objective. As you can see, it can help the applicant in planning his income tax affairs well in advance, brings certainty. It also helps in avoiding long-drawn expensive litigation. India is known to be a long-drawn, litigative country. So this was the idea with which AAR was initiated in late 1990s. And I must tell you, it was a very fascinating concept. And some of the judges who came in were retired High Court, Supreme Court judge, and there were some really wonderful judgments. Clarity came in. Advanced ruling was extremely helpful for especially foreigners who wanted to do business with India, because they get to know in advance what is the amount. But unfortunately, what happened over a period of time, the appointments to these authority for advanced ruling, which had to be a retired judge of the Supreme Court. Look at this is the composition. There will be a chairman who is a retired judge of the Supreme Court, one member from the Indian Revenue Service, and one member from the Indian Legal Service. This was expanded though. When it was started, the chairman will be a retired judge of the Supreme Court, High Court. The problem was appointment of judges were delayed, were not done. Cases were accumulating, piling up. And the best part about AAR is the judgment should be given within 6 months. The ruling should be given within 6 months from the date when you have applied. Now, the provision was also very, very wide. The non-resident can apply. A resident can also apply if he is going to do a transaction with a non-resident, because he needs to withhold tax under 195. So even a resident can apply. And not only cross-border transactions, even for domestic transactions where the transaction value is more than 100 crores, the resident can apply for advance ruling, and public sector unit can also, like the ONGC and Bharat Petroleum, even they can also go for advance ruling to get determination on certain tax positions. So application, who all can scope was pretty good, pretty wide. But now, unfortunately, what had happened, because of these delays and many of the judgments were also, many of the rulings were also in favor of the taxpayers, and the delay and all those things, suddenly advanced AAR became very redundant. So what the government did is, from 1st September 2021, they abolished AAR and have now introduced something called BAR, which is called Board for Advance Ruling. This has come under a lot of criticism in the fraternity because the bar, unlike AAR is a neutral body. There is a retired High Court judge, a Supreme Court judge, and you also had a member from a legal service revenue. But now in bar, as you can see, the bar is composed of 2 members who are nominated by the Income Tax Central Board of Direct Taxes, not below the rank of Chief Commissioner. So there's effectively the Board for Advance Ruling. Jury members are 2 IRS, 2 tax officials. So now you can understand there may be an element of biasism in favor of revenue. So one need to wait and watch whether the bar will be successful, because as a taxpayer, one will be very hesitant to go to bar, because if it is going to be adjudicated by 2 tax officers, the outcome is going to be mostly against you. So what is the point? All the more I will go ahead with the transaction, and then at the time of assessment, I will face it. Could be an outcome. And as I mentioned to you, the biggest selling point was within 6 months. But now, unfortunately, unfortunately, because of lack of appointments, 6 months went to 2 years, 3 years, 4 years. But now, after BAR, we can hope that the advance ruling will come within 6 months. Now, one more aspect that is very important is the advance ruling is binding only on the taxpayer. So, if I have an issue and I go for advance ruling, it is only binding on me. But it can also have a persuasive value, not a great binding value. It can have a persuasive value in other cases. When the AAR was there, Authority for Advance Ruling was there, all the rulings were made public. Now, one is not sure whether in BAR, that is Board of Advance Ruling, whether the rulings will be made public or will it only remain private. We are not sure about it. We need to wait and watch, because this is a new phenomena effective from 1st September 2021. So that's it to do with the advance ruling. As I mentioned to you, very relevant because it gave a lot of clarity, but now it will be very interesting to see how with the new constitution called Board of Advance Ruling, how it is going to be. Will it be effective? Will taxpayer choose? We need to wait and watch. But from an examination standpoint, a question can come as to what is the constitution of BAR, whether the ruling is binding on all other taxpayers. No, ruling is binding only on the taxpayer who has applied. I have also given a question. You can look at this question number 38. Mr. Z, a non-resident, and he has an issue involving computation of income from house property. The same issue persists for assessment year 21-22. Mr. Z's friend has obtained an advance ruling under Chapter 19B from Authority for Advance Ruling on an identical point. Mr. Z proposes to use the said ruling for his case. Can he do it? No. because the advance ruling is binding only on the taxpayer who has sought, but it may have a persuasive value. You can just take the principle and say, look, this is what is done, but it only has a persuasive value. The bar members can also deny it because it is only binding on the applicant who has sought for the advance ruling. So I will not spend any further time on advance ruling because of the fact that structurally the authority for advance ruling is now called as Board for Advance Ruling, and its main essence of being an independent neutral body is now being completely thwarted by having two revenue members who will now head the Board of Advance Ruling. The rest of the procedure remains the same. You can have a look at that in the material, which adequately captures who can apply and when you cannot go for an advance ruling. So with this, I will stop here and I will take up the questions that's come up. Vidula, how to solve in case assessee opts for 115 BAC? Very simple. If 115 BAC is there, take the total income and that's it. Nothing changes. The point is, why will an examiner want to say we opt for 115 BAC? Because under 115 BAC, you will not get any deductions. The idea of the examiner is that they want you to test your knowledge on section 91 and also want to know whether you are aware about chapter 6A and other computation mechanism. That's the, I don't see a question saying no, but anyway, from an understanding conceptual point of view, if 115 BAC you are opting, find out what the total income divided, say, rest of the 91 continues the same day. Non-resident not required to file ITR, then he will avail foreign tax credit. No, non-resident cannot get foreign tax credit. Only resident can get foreign tax credit. So resident has to file tax returns if he comes under section 139. Non-resident will claim the whatever taxes that is deducted in India, he will claim in his home country as a foreign tax credit. A foreign tax credit will normally relieve only by the resident country. Resident country of the taxpayer will relieve double taxation because only in resident country you will have worldwide basis of taxation. Now, somebody asked me right before the beginning of the class, why should we, very good question from Vignesh, why should we tax resident and then give them a relief? Why not directly tax only territorial income? Is there an advantage by following taxing worldwide income? See, Vignesh, the reason for that doing is, I don't have a straight answer. It depends again, because tax rates are determined by each country and tax base, that's why I say sovereignty. So a country would want to have a different tax base, progressive system, schedular system. Some countries have a flat rate. Any income you get, flat rate will be taxed worldwide. So these are all systems and there is no straitjacket formula. Each country, depending upon how they want their economic situation, will decide. India went in for worldwide income because they believed that will bring them more tax revenues. There are territorial countries like Hong Kong, France, where only source. In such a situation, if they are happy, they may have other, you take UAE, they have other ways to earn taxes. So, yes, you are right, but it again depends on how country wants. So, the main relief, again, if you see in foreign tax credit, they are not completely relieving from the overall, whatever is the foreign tax credit, to the extent they are trying to relieve. So there may be still some additional taxes that India will collect. You saw in many of the examples, the effective tax rate of India normally in many situations will be higher than the foreign tax credit. So that way you can get some, India being a high tax jurisdiction, will get some additional tax from the worldwide income. So I get your point, valid point, but unless you have numbers and you see, you cannot move from a worldwide system to a territorial system. AO of CBDT is not well trained. Correct. You're right, Namita. So therefore, they will, if the claim on loss, you have to, if they think the loss is fraudulent, they can always ask. They have powers under section 133. They can always ask the foreign tax officer to verify that also. Income tax has the powers to do that. Foreign tax can be available to foreign supplier from tax withhold. No, I think, Namita, that's the broad understanding. A non-resident will not avail foreign tax credit in India. A non-resident will take foreign tax credit in his home country. If his home country does not give, then he can file and take a refund if he really feels the income is not taxable in India. But normally speaking, how it will happen is, if India deducts taxes to a non-resident service provider, then in the home country, that non-resident where he is a resident of, he can take foreign tax credit, whatever India is. Will you please elaborate on POEM panel? I think I've already mentioned this in before the AO determines POEM, it has to go to a panel which will determine as to whether there is a POEM element into it. So that panel again has as tax officers, the higher authority. So an assessing officer should first go to them and explain that, look, I believe this foreign company has a POEM. And if they also agree, then you can initiate further. But if they say, no, if I don't see a POEM in it, then you cannot go forward. So there's a check mechanism given so that the AOs don't use unreasonable powers. Bar time limit is also 6 months. Correct. Mr. Z can't use, he's not an applicant. Very good. Suppose GAAR override Mauritius treaty, then why Mauritius government will agree to it? Yeah, that's a broader issue. Mauritius government will not be happy with GAAR. But India can always say, look, GAAR is for anti-avoidance. Yeah, our idea is to only eliminate double taxation. Our idea is not to eliminate double or to promote double non-taxation is not the idea. If MLA is to be applied in Netherlands question, what is the impact? India-Netherlands treaty benefit won't be applicable. Similar to GAAR. See, GAAR is a general anti. BEPS MLA invokes the GAAR mechanism in the treaty itself. So to your question, Namita, can Mauritius government will come and say, hey, look, the treaty is very much available. Why did you invoke your domestic law and deny treaty? It's a valid question. Are you trying to override treaty? So to avoid such questions, MLI came into it. So these avoidance rule will now get transposed into the tax treaty. So now Netherlands cannot complain, hey, why did you deny treaty? I will say, look, it is a sham entity. The purpose is only to take tax benefit. And we both have agreed in the MLI that we will not give treaty benefit if the intention is only to get the tax benefit. So I'm denying it. Netherlands will keep quiet and agree to it. So that is the reason why MLI gives the treaty also the same rights where you can deny. So that way there is no question of treaty override and other aspects. So now treaty will also equally have safeguarding mechanisms or wedges to ensure that people don't misuse. So I think I'll stop here. We will start on Friday with equalization levy, the last part of the non-resident taxation scope on equalization levy. So today we look into extensively on Section 90 double tax relief and board for advance ruling. So please do have a look at all those exercises questions starting from 1 to 10. Definitely that will give a lot of clarity and understanding on whatever we've discussed today, and thereby ensuring that you have strong grip on the concepts pertaining to double tax relief. So thank you very much. Good night to you. We'll meet again on Friday.